Jim, can we start there? Mike's talking about it, this tension between what the market's looking for, rate cuts, and what the Fed is looking for next year, anything but.
Yeah, in fact, the divergence between the market and the Fed is one of the largest we've ever seen. You know, the market's got the terminal rate peaking under 5% and rate cuts starting in the second half of the year. The Fed's got it peaking above 5 and holding there all year. So next year, 23, is going to be a year where somebody's got to give. Does the Fed give to the market, or does the market have to give to the Fed? 2022, it's always the market, always talking about pause, pivot, step downs. Most of the time the market was wrong, and they had to come to the Fed. If they have to come to the Fed again in 23 by readjusting their sights higher on interest rates and the terminal rate, and when the Fed's going to start to finally cut, then we could be in for some rough sledding, because I think a lot of the market is hoping that we're going to see some kind of a pivot in 2023, and the Fed is not projecting that right now.
Hey, Jim, your best guess then, you look at that spread right now, it's the market coming up to the Fed and not the Fed coming down to the market?
Yeah, I think so. I think that the market's going to have to realize that the funds rate they think is going to be around under 4.5 by the end of the year. It's probably going to be closer to 5 by the time we get to 1 year from today.
Rob, what about you?
I think the Fed is going to have to come to the market, especially the second half of next year. I mean, if we run several quarters of below trend growth and break evens, continue to come down here, and so the Fed, the Fed, I think, will be in a position where they're looking at inflation really coming towards their target, growth very, very weak. The pressure on them will all be about supporting growth, The inflation, panic will be over. And I think they'll probably be cutting by the second half of next year. So they'll have to come to the market.
So it's interesting you two both disagree on this, but agree on buying bonds. Jim, can you help me work that out?
Well, a lot of that has to do with what Rob said, is that you've got a yield now. So when you started the year and rates went up, you were getting no yield. You were just getting loss from the price. But right now, with a yield, that is a big cushion for bonds. And so while the first half of the year you could see yields go, or prices go down and yields go higher, you're getting paid to own them now, something we haven't seen in quite a long time.